In January 2019, WeWork was the most valuable startup in America, valued at $47 billion. By September, it couldn't find buyers at a fifth of that price. And 4 years later, the company filed for bankruptcy. So what happened? How does one of the most promising startups in the world fall from a $47 billion valuation to bankruptcy in less than 5 years? That's what we're breaking down today. Adam Neumann was born in 1979 in Tel Aviv. His childhood was unstable. His parents divorced when he was 7, and by 22 he'd lived in 13 different homes. That instability would later show up in his management style. Big swings, constant reinvention, very little patience for staying still. Before WeWork, Neumann had already failed twice, a shoe company with collapsible heels and a baby clothing line called Crawlers. Neither worked, and he was even at risk of losing his U.S. visa. Then came the accident that built his fortune. While running Crawlers out of a Brooklyn office, Neumann and his partner, Miguel McKelvey, noticed an unused floor and subleased it. That became Green Desk, an eco-friendly coworking space launched in 2008. They sold it for $3 million and used that money, plus a $15 million investment from Joel Schraber, to found WeWork on February 1, 2010, in Soho. The timing mattered. This was right after the 2008 financial crisis, when commercial real estate was cheap and landlords were desperate for tenants. Neumann and McKelvey signed long-term leases at depressed rates, then subdivided the space to rent out short-term, betting on a real shift. Freelancers and small teams who wanted flexibility, not 10-year leases. But Neumann's real skill was positioning. Traditional coworking companies sold desks. WeWork sold an identity, design, community, belonging. That let him pitch WeWork to investors as a technology company, not a real estate company, and raise money at valuations no landlord could ever dream of. Quick pause if you're getting value from this, hit subscribe, drop a like, and let us know in the comments where you think WeWork went wrong. Back to the story. By 2017, WeWork wasn't just growing. It was expanding at a pace that made it look less like a real estate company and more like a rocket ship. From that single Soho location in 2010, WeWork had opened its 200th location, spreading across New York, Sao Paulo, London, and Seoul. The funding kept pace with the expansion. In December 2014, a $355 million round valued WeWork at $5 billion. And here's the thing worth noting, that number wasn't based on rental income or profit. It was based on growth potential, the same way investors valued tech startups. WeWork wasn't being priced like a landlord. It was being priced like software. In 2016, WeWork raised $690 million in a round led by a Chinese hotel company, pushing its valuation to $16.9 billion. That number is worth remembering, because it's the last valuation WeWork would ever receive that wasn't directly shaped by one investor in particular. That investor was Masayoshi Son, CEO of SoftBank. In 2017, Neumann and Son met for the first time, a conversation that reportedly lasted just 12 minutes. As Son walked to his car afterward, he told Neumann he needed to think bigger. Son wasn't just being polite. Weeks later, SoftBank invested $4.4 billion into WeWork, instantly pushing its valuation to around $20 billion. What made Neumann so convincing? Partly it was the pitch itself. He told investors WeWork was growing faster than Amazon had at the same stage. Partly it was theater. Neumann would do tequila shots in pitch meetings, talk about a coming we-decade, and describe WeWork's mission in almost spiritual terms, elevating the world's consciousness through community. It sounds unusual on paper. In the room, it worked. Skeptical investors who passed the first time came back later and wrote checks anyway. By January 2019, that momentum peaked. SoftBank led a $1 billion Series H round, valuing WeWork at $47 billion, at the time, the highest private valuation of any startup in the United States. And with that kind of capital and confidence, Neumann didn't stop at office space. WeWork launched WeGrow, a private elementary school, WeLive, a co-living apartment concept. It invested millions into WaveGarden, a company that builds artificial surfing pools, and Laird Superfood, a natural foods brand. Each new venture was framed as part of the same mission, reinventing how people live, work, and grow. At the time, this looked like ambition. In hindsight, it was the first sign that WeWork's story was drifting further and further from its actual business. That's the peak. Next, we'll look at the moment the story stopped working, the filing that turned a $47 billion company into one nobody wanted to buy. On August 14, 2019, WeWork filed the paperwork to go public. On paper, this should have been a formality, a company worth $47 billion, backed by the world's biggest tech investor, checking the final box before its IPO. Instead, it triggered the fastest collapse in modern startup history. The problem wasn't the business losing money. Investors already knew WeWork was burning cash. The real damage came from what the filing revealed about how Neumann was running the company. Start with the numbers. WeWork had lost $1.9 billion in 2018 on $1.8 billion of revenue, meaning the company was spending more than $1 to make $1. And in just the first half of 2019, it had already lost another $690 million. But the losses weren't what spooked investors most. It was the governance. Buried in the filing was the fact that Neumann had personally trademarked the word "we," and then charged his own company nearly $6 million for the right to use it as part of its rebrand. He eventually gave the money back, but the damage to investor confidence was already done. That wasn't an isolated incident. The filing also showed WeWork leasing space in buildings that Neumann personally owned, meaning he was collecting rent from the very company he ran as CEO. From 2016 through mid-2019, WeWork paid over $20 million to landlords connected to Neumann. Then there was the language of the filing itself. A financial analysis found the word Adam appeared 169 times in the risk factors section, more references to a single individual than even Tesla's IPO filing made to Elon Musk. Wall Street reads that kind of detail as a signal. If Neumann personally controlled that much of the company's decision-making, structure, and risk, what happens to the business if something happens to him? Investors didn't like the answer. Within weeks, banks that had floated valuations as high as $100 billion were quietly repricing WeWork closer to $10 billion, a nearly 80% drop from its January high. By late September 2019, the pressure had become impossible to ignore. On September 17th, WeWork formally withdrew its S-1 filing and postponed the IPO. Days later, under pressure from SoftBank and its own board, Neumann resigned as CEO and gave up majority voting control. One filing, 6 weeks, a $37 billion drop in perceived value. The story that had convinced the world's most sophisticated investors to write billion-dollar checks fell apart the moment they were asked to read the fine print. That's the turning point. Next, we'll look at what happened after Neumann left and how a company built on his personality tried to survive without him. Neumann didn't walk away empty-handed. As part of SoftBank's rescue deal, he received a package worth roughly $1.7 billion to relinquish control. SoftBank was left holding the bag. Masayoshi Son put together a $9.5 billion rescue in October 2019, and by May 2020 was calling the investment foolish, marking WeWork down to $2.9 billion, a 94% drop from its peak. The pandemic made things worse. Empty offices turned WeWork's core business, packing people into shared space, into a liability, and occupancy didn't recover until August 2022. WeWork finally went public in October 2021, merging with a SPAC at a $9 billion valuation, a fifth of its 2019 high, still bleeding cash. New leadership spent 2 years cutting costs and closing locations, but the core problem never went away: long-term lease obligations against short-term, easily canceled revenue. That mismatch caught up with the company. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy, holding $15 billion in assets against $18.6 billion in debt. In 2024, it emerged under new ownership, Yardi Systems affiliates taking a 60% stake, SoftBank affiliates 20%, other investors the rest, a fraction of the company it once was. Neumann, for his part, didn't disappear. He started a new real estate venture called Flow, reportedly raising $350 million from a major venture capital firm, proof that in Silicon Valley, a spectacular failure doesn't always end a career. That's the outcome. Next, we'll pull out the lessons, the specific, avoidable mistakes that turned a promising idea into one of the biggest cautionary tales in startup history. WeWork's collapse isn't just a story about one eccentric founder. It's a case study in specific, repeatable mistakes, and here are the lessons every entrepreneur and investor should take from it. Lesson number 1, a growth story is not a business model. Neumann convinced investors WeWork should be valued like a technology company. But underneath the pitch, it was still a real estate company, long-term leases, hoping short-term tenants kept showing up. Price a business on narrative instead of unit economics, and you're setting up a correction. Lesson number 2, governance failures are financial risk, not just an ethics problem. Investors didn't flee WeWork's IPO because it lost money. They already knew that. They fled because the S1 revealed a CEO who charged his own company for a trademark he owned, leased buildings he personally owned, and controlled the business almost entirely through personal influence. Weak governance directly affects what a company is worth. Lesson number 3, match your liabilities to your revenue. WeWork signed 15-year leases and rented that space to tenants who could leave in 30 days. That worked while demand was strong, but the moment it dropped, fixed costs didn't move while revenue did. Any business with long-term obligations needs revenue just as durable.